Hello guys, good morning. You're welcome back. This is Charis Trading Institute and we're back to weekly live analysis. Please you can share this the link to this video to as many as you would have access to. Let them join us on today's live session. And if you are hearing me, I would like you to comment on the comment section. Just drop your favorite emoji or let me know that you're hearing me. I'm not sure if my weekly live analysis. Just give me a minute. I'm trying to share links across my social media handles so that others can as well join me this morning. Alright guys, good morning. This is Charis Trading Institute and usually we used to have our weekly commentary, but subsequently I'm thinking of bringing back our weekly live analysis so that those of you who are traders can always jump on it every time I come on live. So, and it's even I think it's better we just run the live analysis all the times. Okay, so quickly let's go through my approach to top-down analysis and how I used to look at price action and how I refine analysis and I bring it down to entry. The first thing I usually do is I go to forexfactory.com, that's the economic calendar, and I'm interested in taking note of high and medium impact news events that will likely unfold during the trading day and going into the week. I'm paying attention to the type of news event and the impact it's going to have on the asset that I'm trading. So I take note of the type of news event the asset is going to unfold on, the time it's going to happen, and the day the event is going to happen, so that we don't get caught by surprise when we start to see speed in price delivery. Okay, because usually what the high and medium impact news will do is that it's going to bring volatility in the marketplace, and in a day where we do not see any of those two indices, high and medium impact news events, it tells us that we're going to have a low volatility day, and it helps us reduce our expectation for the trading day or the trading week. Okay guys, so this week This is Tuesday, 12th of September 2023, and we can see that today we only have medium and high impact news coming up on the Australian dollar 2:30 a.m. GMT +1. This has already happened, and we have another by 7 p.m. GMT +1 on the pound, the GBP, the Great Britain pound, and it has already happened by 7 a.m. Then there's still a medium impact news coming at 10 a.m. on the euro, and this is ahead of us, and these are the only news, high and medium impact news events that we see coming up today. Tomorrow we are going to see another on the GBP, okay, by 7 a.m. that's the opening of London. Then by 1:30, just a little into New York session, there is a CPI news coming on the dollar. So that means we are going to have quite a crazy day tomorrow, and usually we don't want to be in the marketplace when there is a CPI news event, because we are not gambling, and there is totally no reason to subject yourself under high tension or high emotional disbalance, especially when there is such an event. You don't have to be in the marketplace. So by London session, we are not going to be in any trade because there is CPI coming up tomorrow. It's not going to kill you if you stay on the sidelines and just watch what price action is going to do on days like that, CPI, NFP, and FOMC. Okay, guys, so once we are done scouting through the economic calendar, we just go to trading view and start to analyze the benchmark asset. And our benchmark asset usually is the dollar index, because the dollar is the benchmark asset for all dollar associated pair. What it means is that whatever happens to the dollar, it's going to impact dollar associated pairs. So by implication, if the dollar is bullish, we will see bearishness on other dollar associated pair on foreign currencies. All right, when the dollar is bearish, foreign currencies will go bullish because they have a relationship, and the dollar is the main driver of interest rates. Okay, guys, so having established this, we just go to the higher time frames to study institutional order flow, because institutional order flow is the main driver of price action, and the institutions will always focus on the higher time frames, because the higher time frames are the main drivers of institutional order flow. They are the main drivers of liquidity. That's where the liquidity is residing. So we need to go to the monthly, the weekly, and the daily time frame to have a general overview of what price action is doing on those time frames. So this is the dollar index. Previously, we have seen the dollar traded from a bearish mitigation on the monthly time frame, traded down into a discount fair value gap or sell side imbalance, buy side inefficiency. You can see this right here. So price traded down into it, accumulated or consolidated for a while, and we see this sweep of sell side liquidity pool residing below the record lows right here. Price traded again into that fair value gap, and we start to see price heading to the upside. So where is price going to? Because where price is going to will be the draw on liquidity. Okay, guys, so we can see that right now the monthly time frame has formed a swing low, 3 candle price action, where the middle candle has the lowest low. You can see between 1, 2, and 3, the middle candle has the lowest low. This is a reversal pattern that you may like to study on your chart. You can go and do hindsight study and see how price action always respects swing highs and swing lows formation, especially on the higher time frames. Okay, guys, so we've seen this. We know that now we are bullish. But why are we bullish? Because we have a draw on liquidity above. What's that draw on liquidity? We have the relative equal highs right here. There is a pool of buy side liquidity pool residing above it. We have a volume imbalance that was previously tapped into, and we have a wide sell side imbalance and a buy side inefficiency right here. And 50% of this entire fair value gap is called consequent encroachment, and we still have a bearish order block right here and a volume imbalance that was violated. Once price returns to it, is going to serve as support turned resistance. Okay, so you can see we have quite a lot of confluences for the dollar to push to the upside. Okay, guys, please, if you are hearing me, I would like you to comment. Let me know that you're hearing me and you're with me. and let me know that my connection is still intact. Just comment in the comment section. Make sure you are subscribed to this channel if you really want to stay updated with my analysis all the times. Make sure you are subscribed to this channel. Make sure you share the link to other traders you would like to join us. Okay guys, so let me see your comments. Let me see your comments. Let me see your comments. Are you hearing what I'm saying? Yeah, that's great. Since you can hear me, let me just continue. So that's that. On the monthly time frame, you can see how we arrived at what the current institutional order flow is. We are bullish on the dollar. Why are we bullish? Because we have a drawn liquidity above the marketplace, above the relative equal highs, and above that we see that fair value gap or the sell side imbalance, buy side inefficiency, and 50% of that entire gap is called the consequent encroachment. This is a typical drawn liquidity, especially when you have an old high and a fair value gap above it. That is a signature to identify draw on liquidity. All right guys, so we go down to the weekly time frame, and on the weekly time frame we are going to look at what price is doing. So you can see on the weekly time frame, previously we've had price action forming a bearish market structure, lower low, lower highs, lower low, lower highs, lower low, and all of a sudden price gave us a shift of market structure right here where the body of the candle closed above the previous lower high that was formed, and at the same time price was accumulating low resistance liquidity run. You can see all of the highs here, the high here, and the high here. When you have such a high formed consecutively up to 3 times, what we see there is that it forms a low resistance liquidity run. This is not a trend line, okay, because we are trading against the trend line. We see trend lines as liquidity, as a pool of liquidity. Okay guys, so what we are seeing here is that we are seeing a diagonal liquidity, and we are seeing this as a low resistance liquidity because once it forms up to 3 times, that means it will lose, it doesn't have much tendency to resist price action. That's why it's called low resistance. So look at how price pierced through all of that, and we are looking to see price trading to take out the liquidities above the high here, the high here, the high here, and you can see that gap of the monthly time frame. We refined it here into the weekly time frame, and what you see here is clearly a sell side imbalance and a buy side inefficiency. Take note of how I outlined this fair value gap. You can see the low here is the low of a bearish candle, and the high here is the high of a bearish candle. That is a sell side imbalance and a buy side inefficiency. Okay, so what do we see here on the dollar? We see something very simple. We have a shift of market structure. The dollar has been bullish. You can see that the dollar has been bullish. Institutional order flow has been bullish. Just give me a minute. All right, institutional order flow has been bullish. All right, why? Because we see the weekly candles taking out the previous weekly highs consecutively all the times, all the previous weeks. It's been taking out the highs of the previous weeks again and again and again and again and again. That is a bullish order flow, and now it has given us a shift of market structure. All right, so what's ideal to see in this market? What's ideal to see in such a market condition is that we need to see price action at least retrace back into the previous range that was created before taking out the external range liquidity residing above the previous high here. So probably we need to see the dollar reprice into 50% of that range. So when we use our Fibonacci between the low to the high, 50% is somewhere around here, and we are looking to identify institutional reference point around 50% of that range. So what do we see here? We can see that there is a breaker block because price did a lower low before the shift of market structure. So you have a breaker. All right, you have a breaker here, all of this, or we can say that this, the last buy candle here, where the last buy happened before the sell, institutions might like to revisit the old high here to pair up their long positions with the previous shorts that happened here. Right? This is typical. Institutions can and will do that. Alright, even though it looks like they've done it somewhere around here after they cleared the high here, traded back into that previous high where the last buy happened before the sell. Institutions traded back to pay up their longs with the shorts that happen around this level. This is an institutional reference point. But what we are saying is that we're anticipating that at least the dollar is going to reprice into the previous weekly range, because we don't buy premiums, we buy discounts and we sell premium markets. Okay, and as you can see that this is clearly a premium market at this range. We need to see a little bit of repricing, all right, into implied fair value gaps around here. Okay, implied fair value gaps around here, or when you measure 50% of the candle here, 50% of the candle here, this is an implied fair value gap that was violated. We'd like to see it revisited in the future. Okay, this might provide the support we need. This is also a bullish order block. Let's be outlining all of these things. This is a bullish order block. Okay, then you have also a fair value gap right below here. You have a fair value gap right below here that the institutions might come into. All right, so let's go down to the what's the next time frame now, to the daily time frame. And on the daily time frame, we are looking for market structure of the daily time frame. So on the daily time frame, we are looking to see market structure. So you look at the market structure of the daily time frame. Price has been forming higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, traded above the buy side liquidity pool here, and the volume imbalance. Remember a simple hack I gave you on the monthly time frame. I said how to identify drawn liquidity on any time frame is if you see an old high with a fair value gap above it, or an old low with a gap below it, that is a drawn liquidity. So look at this. Price had an old high here. What is residing here? Buy side liquidity pool. Did you see that gap here? It was outlined. Price traded exactly into that level. All right, so right now we're trying to see price. We want to see this price action at least do a little bit of repricing into those levels. So if price is going to retrace or reprice into a discount, do you see that there is relative equal lows here? That is a pool of liquidity, sell side liquidity pool residing below all of these relative equal lows that were accumulated around this level. Okay, guys. Yeah, so what we can do now is that we need to, so we are expecting that price is going to retrace into this level, sell side liquidity pool, and look at this again. There is a fair value gap right below the lows there. Again, what I mentioned on the monthly and daily time frame, you can see it on the daily again. Old lows, fair value gap. That's exactly what I'm trying to anticipate on the dollar. Then on the 4-hour time frame, you can see on the 4-hour time frame we already have a shift of market structure. Okay, sorry. On the 4-hour, we already have a shift of market structure. Price has given us a shift in market structure, and price is currently retracing into, this is a bearish mitigation, and there is a bullish order block with a fair value gap right here. But when you go to the 1-hour time frame, look at what we have. On the 1-hour time frame, we had a gap open lower. This week we had a gap open lower, telling us that we are bearish. Okay, institutions are trying to reprice back into the weekly gap opening. Okay, so I'm anticipating that we might see price, the dollar forms the high of the week around this region. At that gap open, we might see the dollar form the high of the week around here. Okay, before we start to trade down and look at this is a pool of liquidity, sell side liquidity pool accumulated here. You can see another one here on the 1 hour time frame. Excuse me. On the 1 hour time frame, then you can see another residing below where we outline on the daily and the gap below it. So this is my thoughts on the dollar index, and I will do the opposite on foreign currency, GBP USD and the rest. So I'm expecting to see this guy trade above here to form the high of the week around this level before it starts to tank to the downside. Okay, even though again this is a mitigation block, or on the 1 hour it's a breaker. Price took out the high here and gave us a shift here. So whatever happens there, if we see a shift of market structure on 15 minutes time frame around that level, it will be a confirmation for us to start selling. But this gap is my most desired or most preferred point of interest that I would like to see the dollar trading to, and forms the high of the week. Let's go down to the GBP USD. Let's start with the monthly, just an overview since we've already done that. We know what we're anticipating on the dollar, right? We're anticipating that the dollar is going to retrace down. While that is happening, we are also anticipating that GBP USD is going to still push up to the upside before it starts to go down. Okay, because of course, look at what's happened on the GBP USD. Price took out previous low here, traded back into internal range, sell side imbalance, buy side inefficiency around this level. This is also a bearish breaker. 50% of that is consequent encroachment somewhere around here. Okay, you can also say that this was previous fair value gap, previous support and resistance, fair value gap here. 50% of that week, 50% of that week as well is called implied fair value gap. So this might be, this is a gap that was violated. Now it has turned to become resistant. Okay, it has also formed a swing high, telling us that we are going down. Where is the drawn liquidity? You can see that old low here, the gap here, the bullish order block, the previous old low here. All of that is going to be the drawn liquidity. However, on the weekly time frame, let's see what's going to happen. On the weekly time frame, order flow has been bearish. Price has been taking out previous weekly lows, and we've even had a shift of market structure around this level right here. We've had a shift of market structure. You can see that. We would like to see GBP USD trade at least into that breaker. You can see that bearish order block as well attached to the breaker block, the bearish breaker, this bullish order block. We like to see it trade up into that level before it starts to tank to the downside. Where's the drawn liquidity? You can see all of these one-sided price delivery here. It's called a liquidity void. We like to see it rebalance. Institutions would like to rebalance this inefficiency. Then on the daily time frame, we are paying attention to market structure. You can see market structure has been bearish, lower low, lower highs, lower lows, lower highs, lower lows. It accumulated for a while now. It cleared the low here, the last lower low, the last higher low before the higher high. Now we are below it. This also looks like a flip zone. You can see the first low here, another low, another low, another low, another low. We like to see this guy trade up into that flip zone, into that bearish order block of the weekly, into that bearish order block of the daily time frame. As you can see here, you can see that. Now pay attention to something very clearly here. Look at the tiny fair value gap right at the weekly fair value. It was left untouched. That is a bearish order block with a fair value gap attached to it. The last buy candle here that was traded through by 2 consecutive sell candles. that is a bearish order block, and it has a fair value gap, meaning that that's the most valid bearish order block. Okay, I'd like to see this guy head for it during the week. It may take us 1 or 2 weeks to get here, but that's my main target in the meantime. All right, so where are we now? I think price is revisiting the previous gap open of the week. Let's go to the 1 hour time frame. I hope you are taking note of how doing my top-down analysis from the monthly, weekly, daily. So look at what happened this week. Price consolidated for a while, then gave us a shift of market structure. We've been bearish previously, lower low, lower high, lower low. Now we have a shift of market structure because we are above the previous lower high that was formed, and we had a gap open lower that pushed us above that level. Price has traded back into that gap open higher. Sorry, I meant to say gap open higher, not lower. Price has traded back into that gap open higher. Now look, take note of this. Remember, the dollar is at a bearish mitigation block. This guy is currently at has currently repriced into the weekly gap open higher. We are not chasing price action. Okay, in my opinion, this might be the low of the week for the pound dollar. For the pound dollar, while that might be the high of the week for the dollar, this might start to trade and head for this level, while the dollar is going to start tanking lower. Okay, this to me is also looking like a smart money divergence. But what is smart money divergence? Smart money divergence is a cracking correlation. So let me just have a glance on Euro USD to see if we have something like that. Okay, so we do not have a smart money divergence yet. A cracking correlation between the dollar, the GBP USD, and the Euro USD, guys. This looks like a smart money divergence. Why did I say that? Look at this. There was an old high here that was taken, so price from the higher high here traded into that bearish mitigation. You can see that the last sell candle here before the shift of structure, price traded back into it after taking out the high. So what do you see here? You have a higher high. Let's check GBP USD or Euro USD. You see GBP USD, do you have a lower low at this level? No, price traded down into that gap. Here you have it. Took out the low of 1 o'clock of Monday. You can see that. Took out the low of 1 o'clock. Let's see GBP USD. Where is the low of 1 o'clock? 1 o'clock, 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 1 o'clock of Monday, Monday 1 o'clock. You can see that. Let's see if it takes out the low of that Monday 1 o'clock. If it doesn't, then we have is a shift of, okay, I think it did here. So we do not have a smart money divergence. So what I would like you to do now is just check your lower time frames, 15-minute time frames. You can still identify smart money divergence from those time frames. But how are we going to buy this guy when we see a clear confirmatory entry on the lower time frame on the 15-minute or 5-minute time frame? Once we see a shift of market structure here, something like this, either price gives us something like this. Okay, once it returns into internal range, we will buy, stop loss below this, and we'll head for this. Where is your drawn liquidity? The old high here, buy side liquidity pool. The buy side liquidity pools here, that's your drawn liquidity. Or when we see something like this, our second entry model, when we see price action does something like this, mitigation block or shift of market structure and returns into internal range, we will buy this guy into all of those liquidity pool. I really hope that this session is insightful. I'm still going to come back live by 10 a.m. because I'm running a 3 days bootcamp session with my students, and today we are going to do a strategy session with them. It's totally free. Alright guys, if you're interested in my mentorship, you can as well just go through the videos on the channel. You'll find a link where you're going to be redirected to join my private mentorship community. And I would like to advise you to stick with risk management while you are trading. Trading is highly risky and you should lower your expectations so that you stay long in the game. Make sure you apply proper risk management when you find the setup for your trade. And I wish you all the best in today's trading and going into the week. Until next time, I wish you good luck, good trading. Stay safe.